Hello, students. Welcome back to our last part of our course. These remaining weeks are going to be very interesting. We're going to see on today's week's content, on this week's content, what it's called derivatives, the options derivatives. We saw the previous sessions before the exam terms. The future of and what it's a forward on how can you hedge your risk exposure, and it's very related to the exercise that we've been working with regarding how to hedge the risk. But remember that we were missing some instruments that I told you we're going to see in the future. This is one of those instruments. In the incoming weeks, we will have our final topics, which are related towards corporate governance and internal control in companies. Super interesting content, and it will help you all the way along your careers. But let's get to the options, which are derivatives, that are financial instruments. And remember that the focus of this program is not to make you an option operator. It's for you to understand and to see how you can use these financial instruments in order to mitigate your risk exposures. So you can go with actually the ones that operate these options or these derivatives are certified to operate this, and you know that you can contact them if you're in a risk exposure position, and you can use these instruments. Why is not that well known? Because in Mexico it's a little bit expensive than in other nations. You can operate in the Mexder market, which is the Mexican or Mexico Mexican derivatives market. But I would encourage you to go get closer to your banks or to a or to your forex broker in order to operate these financial instruments. So let's begin. Okay, to demonstrate how options work, I'm going to tell you a little story. And by the way, if calls and puts are all ahead to you, then you've already got a leg up. So the method I'm going to teach you afterward will be even easier for you to apply for options. Okay, here we go. So Nicole is selling her house for $500,000 in a neighborhood that has a nearby parcel of land that is for sale as well. And there are two parties interested in their land. Let me show you the two parties, which is Miguel, that plans to develop the land into a beautiful park. And we have Kike, myself, that plans to build a low-cost housing development. So Paola comes along, and she is interested in buying Nicole a house for a cash deal. But she has a problem. He won't have the cash available for 3 months. So she's, of course, worried that the house will be sold as for someone else in the meantime. So she decides to offer Nicole $5,000 or the option premium right now if she'll take the house of the... Wait a second, let me see if we're recording. Yes. If she'll take the house off the market, I give her the option this would be called the call option to buy the house for $500,000, which is referred to as the strike price. At any time within the next 3 months, which is the expiration date. Now, if she does not elect to buy the house, Nicole keeps the $5,000 premium and Paola walks away from the deal. If she does elect to buy the house or exercise the option, Nicole still gets to keep the 5,000 and she pays her 500,000 for the house. Now, three things could happen in this story, in this scenario. But let's review the scenario. So in the first scenario, Miguel buys the nearby parcel of the land. This, of course, will increase the value of Nicole's home to say $600,000, in which case Paola will be very happy to exercise her option to buy the house for $500,000. So in scenario 2, I buy, or Kike buys the parcel of land, and this, of course, as I'm gonna build a low-cost condominium, so the parcel of land will decrease the value of Nicole's house. Let's say for $100,000, in which case Paola will not exercise her option to buy at $500,000, and she'll just walk away from the deal, having lost only $5,000. And then we have a scenario 3, where neither party buys neither party buys the nearby parcel of Susie's house, and it's still worth of Nicole's house, and it's still worth 500,000. So, and Paola can elect to exercise the option to buy the house for 500,000 or not, and simply walk away from the deal, losing only $500,000. In effect, Paola is controlling a $500,000 asset for 3 months for only $5,000. No matter what happens during that time, the most that she can lose is 5,000. Nicole, on the other hand, is happy to take the $5,000. Says she had no guarantee anyone else would buy the house at her asking price, nor did she feel that nearby parcel of land would sell anytime soon. Here's a footnote to the story. Depending on the circumstances, if Nicole felt she was likely to attract another buyer in the near term, she would have demand more than $5,000 to Paola as the house to take the house off the market for 3 months. Likewise, we call options, the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. So now let's define this whole exercise that I made for you on trading terms, on an actual trade example. Just give me 1 second. So a call option is a contract between two parties to exchange a stock at a strike price via the determined date. One party, the buyer of the call, has the right, but not the obligation, to buy the stock at the strike price by the future date, while the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, let's review a trading example. If a stock is trading at $50 and you think it's going to go up to $60, you might buy it at 55 call option for say 20 cents. If the stock rose to $60, that would allow you to buy the stock at 55, even though it's valued at 60, netting you a $4.80 profit on each share. You can trade shares with currencies because we were watching currency, but remember that currencies and shares are also assets. On the other hand, the person that sold you the call would be obligated to sell you that stock at $55 and at a loss of $4.80 if the stock never rises above $55 by expiration date. The call expires worthless, and the call buyer is out of 20 cents, and the call seller keeps the 20 cents. Okay. So remember that we have the call option, which is the option to buy, okay? And in the same call option, we have like two entities, the buyer and the seller, okay? So now let's review the put options. Let's look at put options work by revisiting a little bit of Nicole Paola's earlier stories. So Nicole owns a car worth $40,000. She's concerned that her car might be damaged in an accident or even stolen. So Nicole decides to buy a zero deductible insurance policy, or called a put option, on the truck on the car for the full amount of $40,000, which would be the strike price from Paola Auto Insurance Company. Paola charges $1,500 premium, that would be the option premium for a 1-year policy, 1 year being the expiration date. Now, 3 things could happen in this story. So in the first scenario, we have Nicole car that it's not damaged or neither stolen during that year. So Paola keeps the premium of $1,500. Nicole is okay losing that money for the protection that she provided to her for the year. And in scenario 2, Nicole car is damaged in an accident, requiring $10,000 in repairs. She exercised her insurance policy or her put option by filing a claim in Paola, and Paola pays her $10,000 for the repairs as agreed. Nicole is happy that she purchased protection for this possibility. And in the third scenario, Nicole car is stolen and she exercises her insurance policy, which is her put option, and files a claim but this time for the full replacement value of her car. And Paola pays her the full amount of 40,000 to buy a new car. So Nicole, of course, is very happy. She purchased protection for this possibility. And don't worry about Paola, because in any case, Paola is happy because she sold many such insurance policies, so many different put options to other drivers, most which never file a claim or never exercise their options, providing her with a net profit overall. And there's a little footnote to this story. If Paola, sorry, if Nicole had a poor driving record, that's more risk to Paola. So she would charge her more than the $1,500 for the 1-year insurance policy. On the other hand, if Nicole had an exemplary driving record, Paola could have charged her Nicole less, as the risk would be lower. Likewise, with put options, the higher the perceived risk, higher the premium demanded by the market. So let's look again at a definition and a trading example of a put option. So a put option, it's a contract between two parties to exchange a stock or an ETF at a strike price, or well, ETF, stock, or currency at a strike price by a predetermined date. One party, the buyer of the put, has the right but not the obligation to sell. Remember that in the call option was to buy. This is the right to sell the stock at the strike price by the future date. And in the other party, the seller of the put has the obligation to buy the stock or the asset from the buyer at the strike price if the buyer exercises the option. So let's review an actual example. So if a stock is trading at $50, and you think it's going to go down to $40, you might buy a $45 put option for, say, for 20 cents. And if the stock dropped to $40, that would allow you to sell the stock at 45, even though it's valued at 40, netting you a $4.80 profit on each share. On the other hand, the person that sold you the put option would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the point expires, the put option expires worthless, and the put buyer is out of 20 cents, and the put seller keeps the 20 cents. So that's all for the call and put options, the derivatives. So this was our last financial instrument, and I actually invite you to review a movie regarding this, which is called the Big Short, with Christian Bale, and they explain a little bit about some financial instrument which were options, real estate options that created what was the market crisis of the 2009, early in this decade. So So thank you very much. Don't forget to make your weekly quiz and see you next week. Thank you.